Hello, 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 and welcome to another episode of Next Gen Industrialists, the podcast where we dive deep into the forces shaping the future of industry, from advanced manufacturing to industrial automation and resilient supply chains. I am your host, Belinda Ibrahim. Before we dive in, a brief word about our sponsor. Catalyst Point with a K represents purpose driven entrepreneurs through the complexities of mergers, acquisitions, and divestitures. Their strategy led approach to investment banking has made them the leading M&A advisor for premium sell side deals and buy side acquisition strategy in the industrial tech sector. Today, we are diving deep into the world of venture capital with Laurel Mintz, general partner at Fabric VC. Laurel brings a fresh perspective to venture investing, focusing on women and underrepresented founders while challenging traditional VC models. Let's explore how startups can navigate the funding landscape from early rounds all the way through a successful exit. Laurel, welcome to the podcast.
Thank you so much for having me. Such a fun and important conversation.
Absolutely, absolutely. I want to thank you so much for spending time with me. This is a real privilege for me to invite people into conversation. When I do these things, I always liken my interviews to the indigenous African traditions of storytelling in community. I'm going to start, but before I do, I want you to know that you are in absolute control. You can choose to not answer a question or answer the questions any way that you want to. Before we dive into the mechanics of venture capital and how we can establish a playbook for startups, I'd love to understand your origin story, how you got into being in a VC, and what drove you to challenge the traditional VC model.
Thank you for asking the question. I happen to be Jewish, and so we also have a rich storytelling tradition. So I love that we both have that in common.
Yes.
I started my career as a corporate M&A attorney. I have an MBA in digital marketing as well. The universe, as it often does, has a different plan for everyone. And my dad ended up getting sick. He's healthy now, which is a blessing. But I ended up having to step in and take over his interest in a company called Bassett Furniture, which is a large national furniture chain. Most people are very aware of it. I don't know. Do you know the brand? Are you familiar with the Bassett
Yes,
brand? So a big
absolutely.
national chain. So at 26, I was interim CEO of that company, which I know 26-year-old should be in charge of anything as far as I'm concerned. But there I was. We were able to exit that company 3 years later. I started my marketing agency, Elevate My Brand, in 2009. That's now been around for 16 years. And there, my team is and has been 100% diverse since day one. That's always been part of my mission and alignment. Also, because of my legal background, a lot of private equity and venture firms naturally came to us to market them. And one day, one of those GPs was like, you need to go do this work as a venture capitalist. You have this amazing early deal flow, this true commitment to diversity, and this marketing special sauce. And that's really how it all started. I thought, oh, I can't do that. I'm an operator. It's not for me. Very flattered. And then I started looking down the rabbit hole of venture, saw the lack of diversity in the space, and saw how I could have more impact by infusing these amazing founders that we already saw with capital.
Interesting. What was it about the traditional VC model when you first got into this space that made you realize that it was fundamentally broken?
Well, let's start with who receives capital first, right? That's kind of a no-brainer broken model. And I didn't realize that early days. So I'd been an LP in two funds at that stage of my career, but I hadn't until I started researching what being a GP would be like that I saw the 2% number. And for those that are unaware, I'm sure you're very well aware, less than 2% of all venture dollars goes to folks that look like us here. But the other side of that, which I think the really exciting piece and the piece that really projected me into the concept of launching a fund, was the 25% number. And that number is that when people that are underrepresented founders do receive capital, on average, they return at a 25% higher return rate. And when you think about it, it makes sense, right? We've had to be scrappier with less. We haven't had any inkling that we would, or thought that we would actually receive capital. So when we do receive it, we make $1 stretch to 5, and we're really scrappy. And so when I saw those two percentages together, that's when I saw the business model, because I want to be very clear, like, we're capitalists, right? We're here to make money for ourselves and for our investors, but there is absolutely a model where you can do good and do well.
So just so we understand and clarify this for people. So in terms of the aspect of the GPs that are receiving the money, right? 2% of can you quantify the market for VC funding? I'm just curious. Would you happen to know that?
I don't know the number off the top of my head, but just to clarify, it's both on the GP side. So less than 2% of all GPs, general partners that run funds like what I run, are
right.
women and people of color. But the bigger, I think more impactful number is that less than 2% of all of the global dollars in venture also go to founders who are underrepresented or underestimated, as we like to call it. Yeah. Right. So there's two issues. One is there's not people that are actually deploying capital that look like us. And then there's not people that are receiving capital that look like us. So if I could solve for both of those, I thought that there was a real opportunity there. And the funny part is, Belinda, is that like all of these other GPs who are, as we lovingly say, pale, male, and stale, they have their call to action is to make their LPs money. And if the returns analysis shows that diversity of thought, diversity in boardrooms, diversity in entrepreneurship returns better multiples, returns better revenue, returns better everything, then what does that tell you? It tells you that it's really simply all the isms that we already know exist in the capital markets. And so that's really what we're here to change.
I think for me as a capitalist, it just kind of, frightening that only 2% of venture dollars go to underrepresented founders, underrepresented GPs, yet we actually produce 25% more than standard average returns. Then why isn't anything being done about that to redirect those dollars into underrepresented founders and GPs?
Because the folks that make those decisions at the highest level and who had access to those capital, to that capital, have been making deals on the golf course. They've been making deals with their, bros that have been in the same Ivy League schools as them. So there's been this kind of good old boys club that hasn't changed since venture started. So I think now we're starting to see a little bit more of folks that look like us on the deployment side, which I hope will change, but it's a very, very slow churn. But you tend to, flock with the same folks that look like you, that came from the same backgrounds as you. And if you are pale, male, and stale, then that's who you're going to invest in. That's who you're going to deploy capital to. That's who you're going to raise from. It's this perpetuation of this cycle of behavior.
Yeah, I think they call it pattern recognition bias.
Yes, exactly.
Yeah. So how does Fabric's investment approach, considering the headwinds that we're playing against, how do you differ from conventional VC?
I think that the starting point has to be with the returns, right? So I think there's a lot of anti-ESG movement happening right now, and we're very aware of that. That doesn't change our thesis, but it does mean that we want to lead with returns. We want to lead with being capitalists and what investing in what happens to be diverse founders can return from in our pocketbooks, right? And you can't deny the metrics on that. So if you lead with the numbers that show the returns are better, then it shouldn't matter who you invest in, first of all. Yeah. But to us, it does, right? So I always lead with the capital returns analysis. I lead with being a capitalist. And then I show what our founders are capable of. So we have recently deployed our first tranche of capital January. We have 11 portfolio companies. And in the last, 8 or 9 months now? No, 11 months. We're in November. I'm like, what month is it? 3 of those 11 companies are already raising their Series A. So the markups on that is the proof in the pudding, and we lead with that. And the other side of it is that our approach is significantly different because we come from operating background. And so we have this marketing layer of diligence and a second layer of equity on the companies that we have high conviction on, that we double down on, so that we can control the narrative of success for these brands and, again, really prove the model. And the thesis there is that we will provide outsized returns, top decile returns for our LPs.
Okay, so obviously this is very much at the fund and firm level, right?
Yes.
So your journey really highlights why different perspectives are needed in venture capital, in investment banking, in financial services, period. So let's explore how this shapes your investment approach. So when you get an introduction to a startup, what is your step-by-step process for evaluating these companies?
It's a great question. I really tried to operationalize that process because, like anyone else, I obviously have my own bias, and I want to eliminate that as much as possible from the operational process or the deployment process, the diligence process, really. So it does start with my network, of course, but we're very clear on our focus. And now that we are planting a flag in the ground and saying this is only who we're investing in, those are the deals that we see. People don't waste our time. And we're very clear about that. So it starts with the layer of diverse focused founders, because we think that they're better and they are a better investment. And then it leads down the path of the founder relationship. So I have a call, or I'll invite them to our pitch day. So we've really built an ecosystem. And in that process, I get to know a little bit about the product or service and a little bit about the founder or the founding team. I drop that all into our deal room, and I pick at the end of each quarter, or at the beginning of prior to a deployment cycle, let's call it of 250 deals we see, I pick 20 deals or 20 founding teams that I think are very much aligned within our thesis. So not just from a diversity perspective, but are they consumer tech? Are they future of healthcare? Are they fintech? Are they future of work? Are they in the categories that we focus on, obviously? And then, do we think we can add value with either the marketing side or operating expertise, our network? From there, I really try and take myself out of the process. Again, I want to remove as much bias as possible. And so those 20 or so companies go to our investment committee, which is made up of 3 internal team from our board. It's a diverse team. And they then go through and they either approve, reject, or question the first layer of choices that we've made. Feel free to stop me along the way, because I'm just going to keep rolling if that's any questions. Keep going.
Keep rolling. Okay. And that's why I'm making notes, and then we can definitely come back and see what makes sense.
Cool. Then we've got an outsourced diligence team, because we're a small firm. This is a proof of concept fund initially. And so I knew that I wasn't going to be able to hire a full diligence team internally. So we found an external team that then goes through and looks at about 300 data points through their deal room, including things like their roadmap, all of their legal documentation, the founding team's background, what does the product roadmap look like, how does their marketing stack up, all of these data points, and then they give us a score. Of that score, let's say we've looked at 20 companies, we'll then take the top 7 to 10 and run them through a second layer of diligence that's marketing focused. We call it the fabric thread count, because we had to be clever, because we're marketers at the end of the day. Yes. They get another score there, which tells us how they're doing compared to their direct and aspirational competitors in their space, right? From a marketing perspective, omni-channel. What's happening on social? Is the brand strong? What does their content and creative look like? What are their Google ads, if they're running any, all the ads and marketing channels. And we combine those 2 scores, and then we invest in the top 3 to 6 companies, depending on how much capital we have to deploy at that given time. So it starts with my perspective, which it kind of has to, because I am the one that's bringing in the teams and adding the value. And then we try and back off the process and really operationalize it, so that we're coming at this from a metrics perspective to make the final decisions for deployment.
It sounds like not just from an operations standpoint, but also from a technical standpoint, the funnel that you have, all the way from 250 potential portfolio companies, all the way down to 3 to 6 companies that you then decide to invest in. How long is this process typically from the moment that a startup submits a pitch deck to you? And
Depends
then,
on, it depends. It depends on the deployment cycle. So we get companies at all ages and stages. And, for example, we had just deployed capital in January. So the companies that then sent their decks had to wait another 6 months, 5 months to really get back into the loop on diligence. So it depends on what timing. But we have, again, to your point, a really defined funnel. So people go to our website and the contact page, they can apply for funding there. That drops them automatically into the deal room. And then our IC looks at it along with me, for each deployment cycle. And one of the other things I really pride ourselves on is creating an ecosystem. So even if we don't end up investing in one of those companies, we may invite them to the podcast. We may invite them to the pitch day. We may promote them on our social channels or through our newsletter. We have a 40,000 person database. So it's more than just making decisions around investing. Of course, that is our focus, but we really are about bettering and building a stronger ecosystem within our networks.
Yeah, that's crucial. Just so people understand, what is the deployment cycle?
Deployment cycle is the time with which you decide from first point of contact to cutting of a check, or really don't cut checks anymore. I think it's funny people still say that, to transferring the money, that cycle. And it can differ from, it could be 6 months if we've already deployed to, if we have really high conviction on a company and we're late in the diligence with a bunch of other companies, that might be as quick as, 5 to 7 weeks.
Okay. But it does take time.
It does, although we've really narrowed, because we don't have a huge team, right? So we are pretty quick and nimble in how we approach our diligence process.
Yeah. So you mentioned the kicker with having investing in diversity, however you want to define that. How do you feel that actually does help your portfolio companies balance growth with sustainable unit economics?
I'm not sure I understand the question, like that being a diverse founder impacts that?
Yeah. Let me reframe it. We talked about, you mentioned, diverse founders and GPs tend to be more scrappy, right? And so when they do get that investment, do you feel that it actually helps them growing faster with more sustainable unit economics? What strategies have you seen work?
Got it. I think we're a little early to make an assessment on that because we just did our first, and second deployment. So we're about 9 months, 10 months in on our first investments. But I think historical metrics would prove that model, right? So when we look at all those data points, as I mentioned during the diligence process, we're already looking at unit economics, and they have to be really strong across every channel. So, folding in the capital piece absolutely helps them grow and hopefully hockey stick quicker. And then in addition to that, and again, part of our thesis and why we believe our fund will provide top decile returns is the added value of the marketing piece. So what we typically see in the fundraise process is something between 50 and 80% of use of funds is focused on marketing. So if we can solve for that early and often, and also not make these companies immediately cash poor by having to pour out capital into their marketing, then yes, the economics they'll move faster and they'll have a longer runway. That's our thought process on that.
Are there any particular key metrics specific that you would like founders to be able to demonstrate as part of that due diligence process?
Well, I'm a marketing girly, so I really like to focus on that. My other teams obviously focus on other metrics, but I'm really looking at things like CAC, LTV, a lot of the marketing metrics and KPIs that we know a company needs to be successful, especially on the consumer tech side. It's a little less focused on that, I would say, more on the service side or on the future of, like, especially healthcare is a long runway or long timeline for a lot of those companies to hit profitability. But for me, I really love to look at the marketing components. But there's 300 different data points that we look at specifically, but where I always add value is on the marketing side. So that's where I focus my efforts and thought processes.
Okay. I'm curious about, obviously, hard tech startups, which is kind of where I also focus on. How do you access if you do get a hard tech startup that maybe fits within your sweet spot? How do you assess the scalability of that business?
Yeah, I wouldn't say we haven't really invested in hard tech, although we just got a deal sent to us. Can't remember the name of the company off the top of my head, which is a problem because from a marketing perspective, that means they're not a strong brand, but it's a wearable. So it's a deep tech company with a wearable component. So it has software and hardware, which is not really our focus. We have a little bit of aperture in terms of where we can cherry pick companies. And again, if my IC feels really strongly about it and the economics are there, we would do that deal. But typically that's not our main focus because again, we just don't have category expertise. But this one in particular was really fascinating. I think they're going to be a really great competitor to the Aura Ring, which we all know has been massively successful. But hardware and software is hard just from an economic standpoint, right? The amount of capital needed to build the software, to build the product itself and ship all that is, exponential compared to a consumer tech brand necessarily. I guess that could be considered consumer tech. Maybe that's why we fit into the category. Right. But it's a little different than other, I think, more easily scalable categories.
Yeah. Are you seeing any impact that AI has on startup valuations?
I mean, yeah, of course. I mean, everyone, AI is the sexy beast in the room, right? It was like what metaverse was 3 to 5 years ago. Everyone likes to mention AI and they do on all of our pitches. And I always like to call them out. I'm like, do you really have AI or do you just have a little like talking monkey in a corner room putting data into a spreadsheet? Because that's the truth about most of these companies is that they are pitching the concept because they think it's sexy, but they actually don't have it, or they shouldn't build it, they should buy it, right? So we often have the buyer build conversation. AI is where majority of venture dollars have gone in the last year. We've all seen that. So absolutely has to be part of the conversation. For our companies, there's some integration, certainly in AI. We have for example, a 3D printed casting company, and they use AI technology to do all of the scanning for any body part that needs to be casted. So it's a component. And of course, technology, if you own and have built a technology that has some sort of AI integration, your multiple on that's going to be higher. So yeah, the valuations certainly are impacted by AI.
Yeah, I'm just wondering, it would be interesting when you talk about calling founders on their BS, so to speak, when they mention AI. And so how can founders sort of like be pragmatic when you're talking to investors about how AI is the creme de la creme for their business model? But then when you go through due diligence, they don't end up being one of those 3 to 6 companies that you end up investing in. So what should they do and what shouldn't they do?
That's a really good question. I don't know if I have a perfect answer for it, but I would say certainly address the elephant in the room, right? Like we believe AI is going to be really impactful in our business because of these 3 points, and make sure that that's real, right? Like don't just say that it's going to be impactful because everybody needs to talk about AI in their pitches. And then again, to my point earlier, like talk about whether it's a buy or build moment. Like a lot of these companies really just need to buy some of the GPTs and build layered on top of that, right? Technology on top of what's already been spent billions of dollars building. So that doesn't need to be a huge component of their use of funds. So I think it's a combination of being really clear on the why behind AI as an integration. And I do believe it impacts and will continue to impact every single one of our investments and every single one of our life categories, right? It's like, it's here to stay. It's just a matter of those founders being really clear on their why and the how, I think.
Yeah, that makes sense. Aside from that, what other common due diligence red flags should founders address before approaching VCs?
They have a messy cap table. That's a really challenging red flag. I know a lot of founders, especially diverse founders, have a hard time raising capital. And so sometimes those cap tables can be really messy, but I would absolutely recommend that those cap tables be cleaned up before they go out for institutional capital, because it's something that is a huge turnoff for venture funds, especially if they're going after larger, more institutional venture funds. Like, we're a new fund, we're a proof of concept, we write smaller checks, but if you're going after the larger venture funds and your cap table is messy, that's going to be a pretty instant red flag.
For the broader audience, when we say messy, what does that mean? How should they visualize that?
Yeah, it means that
100 cousins that contribute, friends and family. I really want this conversation to be real, because if we don't say these things, if we just say, oh, messy cap table, it's like, okay, what does that mean? Does that mean that you can't really, when you do a friends and family round prior to going to institutional investing, what should you do correctly and what shouldn't you do, or at least keep in mind in terms of going out to raise capital?
Yeah, I think the number one thing is giving away too much equity early. So that's usually a concern, because obviously as you go out to raise your equity as a founder and anyone who's an investor, it's dilutive capital oftentimes. So you want to make sure that you can still maintain enough significance in terms of ownership that a capital raise from institutions makes sense. A lot of founders will give away the farm early days because they just don't know any better. And then to your point earlier, if you've got 1,000 cousins on the cap table, that's fine, but like, clean it up before you go out for institutional. Make that one line item, separate that out into its own grouping, so that an institutional round can come in and not have it be so messy. So I'm not saying don't go do that, because obviously get the money, honey, but yes. But make sure that when you're going out,
keep it clean prior to going out to raise institutional funds.
Yeah.
And I would recommend get a lawyer involved. So it's not just enough to clean up that line item on wherever you're keeping track of it, but to actually hire an M&A attorney.
Make sure it's papered properly.
Exactly. Yeah. All right. So how do you help portfolio companies? So now that you've made the investment, as you know, in addition to marketing, what strategies have you seen work best for startups in figuring out their product market fit and go-to-market strategy?
I would say we've done that work likely before we've made the check. So we will come in and we run this process called the fabric thread count, where we run them through that marketing diligence playbook, right? So we're looking at them from an omni-channel perspective, so that we can come back to them and say, all right, if we write this check, this is what needs to happen to clean everything up from a marketing and product market fit as part of that, obviously. At that stage, it's about execution, I would say. So in that roadmap, we literally come back to them and we say, here's what the scope needs to look like for you to be successful with this brand. And they need to commit to actually executing on that, whether with us or not. Like, we're not, we don't tie our checks to required execution, but we really recommend it. And as long as they're working with the right teams, and I think that's another big piece of it, is like, a lot of use of funds is then used to hire the right partners, the right players within the team to then go execute. So as long as we can see a pretty strong process and roadmap to end game or the next raise round, that's when we're happy. And then we'll help them along that path as well. We've got a lot of network, and we are consummate introducers. So like, that's one of my special powers, I guess, my superpowers, is figuring out how to introduce the right folks to the right folks. So whether that's an operating partner, whether that's a marketing team, whether that is other venture funds to close up a round, which we've done a lot of. You know, we've been very intentional about building this venture network, both laterally and up and downstream.
Talk about probably to the startups. There's probably no, it doesn't really matter technically in terms of co-investing, right? But how does that impact maybe the operations or at the board level?
Co-investing?
Mm-hmm.
I'm not sure that it does, because we don't take board seats unless there's lack of diversity on the board. So that's not, and frankly, I always tell people, ask me all the time, I'm like, you don't want me on your board. Trust me, I'm too busy. I'm not going to be a good fit for that for now, right? While we're raising and deploying the fund. Down the path, we'll certainly take more board seats, but I think co-invest is so critically important in startup land, because you're basically handing a deal over and saying, hey guys, this is pre-vetted, come in with us to close the round out. We just did that on one of our legal tech companies, really close venture fund that we work a lot with. We just literally lobbed the deal over, and they had one conversation, and because we already had all the diligence that we could hand over, they were like ready to write the check. So it's about streamlining. I think that's the biggest takeaway, is like when you have a venture fund that's a true partner, the process can be streamlined if they really are willing to make those introductions to, again, those lateral co-invest opportunities.
Yeah, that's crucial, especially, and then given the fact that you've managed to operationalize your due diligence process, so then that makes it even easier for you to partner with other funds and support your founders.
Yeah, we're actually about to do a blast out to all of our venture players in our ecosystem, because we have like 1 or 2 seats left for our next deployment cycle. And I want to make sure that those checks are going to Black and brown founders, and at least with a focus on that. So we're going to do a blast out that says like, hey guys, who's the top of your funnel right now, or who's the bottom of your funnel right now in terms of companies you've diligenced that are amazing, diverse founders that you think would be a fit for our next deployment cycle. So we're really intentional about not just pushing outwards in terms of our connections, but doing an inbound request for potential opportunities like that.
What is the timeline for from from investing, go to market, and exits? I know it differs by company. How do you help companies prepare for successful exits from day one?
That's a good question. We're still learning. If I'm being totally honest, like we are a new early stage fund. And so we're learning that process ourselves. I will say my personal experience, I have a barbell approach in terms of how we invest, my partner and I. So we've seen how that process goes. And I think we'll probably mirror that pretty closely. But there is no perfect answer to that other than making sure all your ducks are in a row from every single channel, from your team to your cap table to your marketing to your future roadmaps, all of that. I would say the one additional thing I would add is being really clear upon your first fundraise on what that exit would look like in a perfect world, right? It could be a pie in the sky dream, but it's actually, to your earlier question, one of the things I like to see a lot when I hear a pitch or when I see a deck is like, have you been thoughtful about who either your strategic buyout partners might be, or are you on track to IPO? Is that the goal? Like, what is the actual exit strategy from a thoughtful perspective from day one?
Why is this important for founders to consider, not just at the time of pitching their startup, but literally throughout the entire operation of their company? Why is this important for them to think about that?
It's a great question. If you're not intentional about anything, whether you're trying to find a life partner, whether you're trying to lose weight, whether you're trying to get from LA to New York, if you're not intentional about the roads, the streets, the car you're going to take to get there, you're never going to get there. So I think it's about intentionality and focus. And if that's not a part of your initial narrative, how, as an investor, I can't in good faith invest in you because you clearly haven't been thoughtful about how to get to that 100 million mark, which is the mark we are really looking for you to target to be a sexy M&A target, right? So it's how are you getting to that first 100 million? Well, really, it's how are you getting to that first benchmark, whatever that might be for you. How are you going to then track to 100 million? And look, these are performance, these are projections, right? These are not, we don't expect you to be held to these numbers. We just want you to be really thoughtful about it.
Right, because at the end of the day, the capital infusion is not free.
Right, even though expensive money. I tell people that all the time, Belinda. I really do. I'm like, so many companies are not venture scalable. And also like, I'm expensive money. I don't know if you want my money.
Exactly. Yeah. And a lot of founders don't understand that piece because I think the disconnect is that they receive the money and they exchange it for equity. And that's all they know.
We're done. Problem solved.
What they don't seem to understand is that money has to be returned at a future date hopefully
Yeah,
at a
we're
future
doing our
date
job right.
and time in order for them to get back either their equity or maybe sell that equity to a new owner of the company.
That's exactly right. You've done this before.
I just like to explain things in simple terms so people really understand, because I think that really is the disconnect. It's like a lot of founders just assume it's enough to raise the money, but they don't understand that the reason why they're even being given the money in the first place is because the intent is to exit out of the investment, which is the startup. And that way they can continue growing and becoming a larger entity, such as an Nvidia or an Apple or whatever the case may be. But until that time happens, then that's when they're going to be forced to exit at a lower valuation because they didn't really understand the end game.
That's exactly right. Yeah. And it's also one of the reasons why I think angel investing is so challenging. Because the truth is that most of these companies do fail. Like 80%, the numbers are staggering. And I think most people don't see that either. And I always say it this way for ease of numbers, but like, let's say you have 10 companies. In venture land, 8 typically fail. One's a 3 or 4X and one's your Google that will carry the entire fund. It's a pretty wild model when you think about that. Like, what other industry other than maybe entertainment is that an acceptable model? So making sure that you're also investing in things like funds so that you can hedge against the downside, which is inevitably going to happen, and companies are going to fail all day, every day in venture land, is also really critically important for investors to know.
Yeah. All right. What are common mistakes you see startups make?
How much time do you have? My top 5? Oh my gosh. Oh, being too cocky. Right? You see a lot of really cocky founders. I like a little bit of cocky, but like you have to be coachable, right? That's part of the process. Being undercapitalized, not raising enough for your runway. So like if you aren't really projecting out the right amount of capital for the raise, then you're going to have to go back and raise again in 12 months or whatever that timeline. That's going to take away so much of the effort from actually growing and evolving your company. I definitely don't want to see that. Lack of follow-up. Like you'd be shocked as to how many times I get like, oh my God, you're the perfect fit for as a venture fund for us. Like, I'm going to send you my deck. And then like, or they send the deck and they don't follow up after that. Like, I'm busy. You better like come back for me, or like just even keep me in your loop. And I love the companies that put me on their newsletter list so that like they don't have to personally reach out. They can just get me on, I get on the distro list and I can see the updates. And I can't tell you, like I've reached out to a couple of those, been like, hey, I just got your newsletter. It looks like you're really growing traction in the exact categories we talked about. Let's re-engage our conversation. So that's 3. 4 is not interviewing your VC, your investors. I think it's just as important for the founding team to make sure that we're the right fit as it is for us to interview our founders and make sure they're the right fit for us. So I think it needs to be a two-way street. What's the last one? Oh my God, there's so many. Not solving a real problem. Right? Like, don't come to me with something that's like a fluffy. Like, I don't need a fluffy company. There's enough fluffy companies in the world. I'm never going to fund that company. It needs to be solving a real life problem, or be a better solution, a better mousetrap, as they say.
Yeah. Okay. So it sounds as though, let me see how I can rank this. Number 1 would be not solving a real problem. Number 2 would be lack of follow-up, even though I probably would rank that number 1 because I've also had that as well. Not interviewing your investors. And I think this is why I know a lot of these conversations when it comes to the VC playbook for startups, they really talk about it from the startup's perspective, but not really behind the house or back of house, as we say. So that's why I was asking some of those questions. So then that way, founders, when they approach VCs, should at least have some sort of idea as to, number 1, how they fit into that VC's thesis.
Yeah, what added value? Part of the interruption, but I just had a founder ask me this on a call, and I was like, love that. Like, we were just going through all the questions, and I was peppering them, and they were answering them, and it was a great founder, great conversation. And then they were like, so what value add do you bring to this conversation? I was like, yes. It took me back for a second, but then I was like, this is exactly what we want, right? We want them to be as bullish about who they're receiving money from as we are about who we're deploying our capital to.
Yes, exactly. Being undercapitalized is definitely key, because you don't want to underestimate your runway, because then that means you have to go out in a shorter time frame, which actually increases your dilution, right?
Yep,
And also
exactly.
hurts the company because you're not really thinking that through. Is there a way that VCs can, I mean, it's not our job, but is there a way that VCs can help founders that they are investing in better understand exactly how much they really need in order to get to the next goal?
If I have to tell you that, I'm never writing you a check, because you should have a finance team or a fractional CFO or someone on your team that can do that for you.
Right.
Sorry,
Right.
that's a no for me.
Okay. Well, that's why I'm asking the question. Because I do see this problem where they were undercapitalized a lot
Yeah.
of times, and they have to go out frequently to raise money. Coachability, I like that a lot. Founders have to be coachable.
No, we're in this together, right? Like, if you're not going to come to me with good and bad news, like, I want to be the first call when you're like, shit, I've got this problem. I don't know how to solve it. I need help. Because the likelihood is that I can either solve it for you, or I can have someone in my network solve it for you. You don't have to be, a lone wolf. And unfortunately, so many founders think that they have to do this. They have to like barrel through the problems. Most likely, if you've had this problem, one of our other founders has had the same problem that we've solved earlier. So like, come to us and that's what the coachability piece is. Like, be open to the dialogue, be ready for feedback, and ask for it. Like, be able to ask for help. Don't be too proud.
Yeah, I really, I think that's really much needed in the investing world. These were really some fascinating perspectives. Laurel, you've shared so many valuable insights. I'd like to try something different. I'm going to do a rapid fire round where you can give us your instant, unfiltered takes on some popular beliefs in the startup world. Are you ready?
I am ready.
Everyone says startups need to move fast and break things. Is that overrated or underrated?
I think that is overrated. I think marketing especially is an 8-month journey. And so it takes a long time to get to marketing efficiency. I do believe in breaking things fast on certain things, but I think generally it takes time to grow a company. Like, there really is no such thing as overnight success.
Yeah. Okay. Are pitch decks becoming obsolete?
Oh, that's a good question. No, because I need something to refer back to, but I'm never going to make an investment based on a pitch deck. I don't actually love it when founders pitch to me on a pitch deck. I just want to have a conversation. So not in the initial pitch, but I definitely like it for follow-up so that I can go back to my teams and say, all right, here's what we're looking at. Here's the projections. It should have all of that there. I think the data room's more important than the pitch deck, though, I would say.
Okay, I like that. I like that idea. For most startups, especially the founders that we, invest in, is bootstrapping to PMF actually smarter than taking VC money at the start?
Yes, 100% yes.
Okay, and PMF for the broader audience is product market fit. So which means that you get to the point where you have a customer that's actually paying you for the product, and it's not a pie in the sky idea. That would be better than actually going out to take VC money off the bat. Once you've proven PMF, then it makes sense to go get VC money to grow.
Also, your valuation will likely be higher at that point too, so you'll get more for less equity.
Yes, correct. All right. Hot take. What is the focus on TAM? Is it misleading to founders? And TAM is total addressable market.
Yeah, I think TAM is BS. I think SOM is more important, but even those, like, these numbers are all BS, honestly. Yeah, I think that people they have expectations that is listed in a deck so that we can see there's this giant market that needs our help. And then we're going to take this little piece of it, but then we're really going to take this piece of it. I think it needs to be something that you think through, but I do think it's totally overrated. And most of these companies never get anywhere near that song?
Yeah, never, most of the time. Do startups really need a technical co-founder?
Depends on the product.
Yes, depends on the product. Okay. Is the fail fast mentality destroying real innovation? We talked about, is it overrated or underrated? So if it's overrated, is it possible that it's actually destroying real innovation in certain sectors?
Oh, I think that it helps people realize that they're either made for this or not made for this. So if they break things fast, then they can, or if they're like not really built for this journey, like not everyone should be a founder. And I think moving quickly in that particular way helps you understand where you live in the ecosystem. Should you be taking a W-2, right? Instead of trying to build something from the ground up. Yeah, that's a really interesting question. Yeah. I don't have a perfect answer on that one.
And I don't think that there is actually. It really is dependent on the startup and the technology that they are innovating around, and that determines if they should really fail fast in order to realize, okay, this is a roadblock, or maybe they're actually way ahead of their time also.
Yeah, I think my response to that would be more about like developing the right feedback loops so that you can get to PMF faster.
Exactly. Okay, cool. Are accelerators worth it for startups?
Oof. These are great questions, Belinda. You're so freaking smart. I love these. I think it depends on the founder. So if you have been an operator before and you don't need to understand how to build teams and how to build operational processes, I don't believe that they're the right fit because they oftentimes take significant equity. But if you're a first-time founder, that's your first time out the gate, and you have no idea how to stand up a company, it can be very helpful. They can provide you with access to vendors and even some capital. So I think, all these questions, the answer to all these questions is it depends, but it depends on the kind of founder you are and where you are at in your journey.
Okay, awesome. Does pursuing patents too early actually hurt startups?
As an IP attorney, so I'm mostly M&A, but I did some IP as well. Such a hard question.
Gut instinct.
I'm going to say no. I'm going to say no because the process takes so very long to receive a patent. So, and I also think when you're going out to raise on a patentable product, or technology, the venture team wants to know that you're being thoughtful about ownership. So I do think that there's value around ensuring that you are thinking about how IP ownership will land long term. But not everything is patentable. So I think oftentimes founders think, I have the best new idea, the best new product, but they're not really reinventing anything. And so for those founders, I would say, yes, I think that's a waste of time. But if you really are reinventing the wheel literally, go get it protected.
I like that. Okay. Let's go back to diversity in tech. What is the obsession with hiring from top universities? Is that hurting diversity?
Yes, 100% yes. Again, it's that sea of sameness. When I walk into most of these financially focused rooms, it's a sea of black and navy blue suits. And I like to show up in hot pink so that I can make it, look actually different. Although as a woman in these rooms, I am typically different. But yes, I absolutely think that is hurting us at the highest level because it's just that sea of sameness and that perpetual cycle of investing in who and what which I think is bullshit.
Yeah. Hot take. Should more startups be saying no to unicorn valuations?
Yes. I like the word stallion better than unicorn. Unicorns are fictional. Who wants to invest in a fictional company that is growth at all costs? I want a stallion. A stallion is real and it's like the best in class. And that to me is a profitable company.
Good. Okay. Are you currently fundraising?
Always. Yeah, we're about halfway through our raise. We'll be open through next year, and our next close is January. So if anyone's interested, you know where to find me.
Awesome. Wow. These are actually fascinating. I really appreciate your insights and unfiltered answers. So here is a closing round. We're almost halfway through this decade. What excites you the most about the future?
I think younger generations are going to be just amazing. I'm running this agency and I've a big team behind me there. And most of my team are millennials, Gen Z, Gen Alpha is coming next. I just think that they have such a unique perspective. I'm really excited about what they're going to bring to the future.
Yeah, absolutely. I agree. And I think with AI and maybe next is quantum computing. So those would be very interesting to see how this next generation
Yeah, I have a girlfriend who is 19. No, she just turned 21. Just kidding. I met her at 19. And she and I get our nails done together all the time. And everyone's like, you're 45. Why are you friends with a 21-year-old? And I'm like, because I think that she has such a unique and fantastic perspective that I could never have. And she feels the same way about me. And I just think that we just need diversity across everything: age, gender, race, sexuality, all of it.
Yeah, agreed. I got this from one of my favorite podcasters. Imagine it's your last day on earth many years from now, and you've accomplished everything you've ever dreamed of. But for whatever reason, you have to take everything you have ever created in this lifetime with you, including Fabric VC. No one has access to any information about you anymore. They can't Google you, nothing. But you get to leave behind 3 truths, 3 lessons that you want to leave with the world. What are your 3 truths?
Oh my God, this is such a good one. I might steal this for my podcast. I love this. Family first, happiness above everything, and oh gosh, everyone's faking it, so don't let anyone intimidate you.
Ooh, I like that one. I like that one. Everyone's faking it, so don't let anyone intimidate you. Happiness above all else, and family. That's awesome. What's your definition of a next-gen industrialist?
Ooh, a next-gen industrialist is someone that has a unique perspective and is pushing hard in the direction of building something that is game-changing within their industry.
I love that word, game-changing. Where can people find you? Obviously, I have your ticker scrolling below. FabricVC.com.
Yeah, we're also on all of the socials, Fabric Venture on Instagram. We do a ton of content. Our joy in the work is education and empowerment around the asset class, because I think it's time that more of us have a seat at this table. So come to us at Fabric VC, sign up for our pitch days, follow us on all the socials. Yeah, we do a ton of content and we're honored to be here. So thank you so much for having us.
Yes, absolutely, Laurel. And for pitch day, people can actually go on the website and sign up.
There's a navigation in the bar that says sign up for pitch day, and then you get automatically dropped into the deal room, and then our team goes through and filters through, and we pick 6 companies for each pitch quarterly.
Perfect. Thank you, Laurel, for pulling back the curtain on venture capital and sharing a ton of valuable insights for our audience. Your perspective on building sustainable startups and achieving successful exits is refreshing and practical. To our listeners, if you enjoyed this episode, please subscribe, review, and share it with fellow entrepreneurs in your network. Until next time, I am Belinda Ibrahim, encouraging you to aim high, put family first, prepare well, and don't be afraid to keep pushing the boundaries of what's possible. Thank you for listening. And Laurel, thanks again for this insightful conversation. And with that, we're going to sign off the live stream. Bye.
Bye.